Can everyone see my screen? Looking good?
Yep.
Okay. All right, guys. So here are the very basics, right? When you invest on Linqto, you're making investments in a class of assets that basically are shares of private companies. So those shares are unregistered. They're not freely tradable. They're restricted. And as a result of that, in the US, and if you're an American, you are covered by US securities regulation. You have to be what they call, or what the SEC calls, an accredited investor in order to be allowed to make investments in this class of assets, right? So what does it take to become an accredited investor? You have to either fulfill one of two financial tests that have to do with income or net worth, or you have to hold certain securities licenses, right? The income test that you have to fulfill basically requires that you have, as an individual, a minimum of $200,000 in income in each of the past 2 years. If you're qualifying on a household basis, that number is $300,000 in household income in each of the last 3 years, right? Those are the threshold requirements. You have to do better than 200, better than 300 in each of the last 2 years. If you want to qualify via net worth, then you have, there's a threshold of $1 million in net worth, excluding the value of your primary residence, your home, basically. So you take all of your assets, financial, other real estate properties, maybe you own rental properties, perhaps you own a business, and therefore the value of that business counts towards that net worth. So basically everything in your asset portfolio outside of your home, less obviously any of the debt that is encumbering those assets. And that gets you to your net worth. That net worth should be over $1 million, right? And if you can't pass either of those financial tests, you can still qualify if you hold certain securities licenses. And these are specific licenses. They're FINRA Series 7, 82, or 65. You can qualify by holding one or more of those licenses. I want to just explain here, because this is an important distinction. The Series 7 and 82 are licenses that basically require you to be sponsored by and registered with an investment or a securities firm. So, you know, if you're not in that profession, you're likely not going to have those licenses. But the 65 is singular, unique, because you can hold a 65 on your own as an individual without being registered with and sponsored by a securities or investment firm. And that 65 license basically is an investment advisor license. You just apply to the SEC, you take a qualifying exam, and as long as you pass the exam and receive the license, you're done. And you know, you don't have to even operate as an investment advisor, giving advice to other people. You can be doing it for your own behalf. So if you're a person that doesn't meet the income or the net worth test, and you still want to make investments as an accredited investor, we'd highly recommend that you look into obtaining that Series 65. It'll help you become a savvy investor, more educated, plus it allows you to then achieve the accreditation. Is there anybody in the audience that isn't a US national? Because, okay, there you go, Neil. So the rules in the States basically say that if you're non-US, if you're Canadian, like Neil is, right, then your compliance, your qualification to invest on our platform is going to be based on your home country regulations, right? In Canada, those regulations actually mirror the US regulations. They're the mirror equivalent, except, and this is a benefit to you, Neil, that they're denominated in Canadian dollars. So for you, that's a big advantage because you're earning in USD and you're qualifying in Canadian dollars. And right now the exchange rate is in your favor. if you're a non-U.S. national, basically we just ask you at Linqto to stipulate your nationality, and then we can then you know, apply the home country regulations that are pertinent to you and qualify you. I'm not going to spend a lot of time on this because we don't have, other than Neil, people from some of these other jurisdictions. But I will tell you that approximately 25% today of our customers at Linqto are foreign. They're non-U.S. nationals, right? So you're welcome to invest on Linqto as long as you can comply with your home country regulation. You might be wondering who in the heck made up these rules, and we get a lot of emails, some of them quite you know, angry or disappointed at the fact that they have to meet accreditation status in order to invest. We completely get that. We sympathize. Unfortunately, these are not rules that we made up at Linqto. We're simply having to comply with them because the SEC imposes them. The reason for the SEC's regulation is basically, you know, they believe that these types of assets, meaning private equities, represent a higher degree of risk than what, you know, one encounters when investing in public equities. And they're deemed to be higher risk largely for two reasons, right? One, the companies that issue these shares are not reporting companies like public companies, so they're not subject to the same reporting and disclosure requirements that public companies have. If you're a public company, anybody can look up a 10Q and a 10K and get substantial amounts of information, right, about the company's financial standing, its operations, its business, etc. Private companies are not subject to those reporting requirements. Ergo, there's a lot more limited information on those companies. Also, the shares are illiquid, right? They're not listed. They're not freely trading on some stock exchange. And so that illiquidity and the restrictions on the transferability of that stock from one owner to another make those investments inherently riskier. Now, I want to tell you that this second problem is something that we've tried to solve at Linqto, right? So we have an investment structure at Linqto that effectively allows you to take your investment, and if you change your mind in the future because, I don't know, something happens in your life that requires you to get cash, for example, you can encash that investment by selling it to other investors on our platform, right? And even though the underlying shares in which to which your investment is tied remains illiquid. So if you say make an investment on Linqto in Ripple Labs, right? Even though Ripple itself may not have gone through an IPO, and even though their shares remain illiquid, your investment on our platform can be sold to other investors on our platform, right? And so to some extent, we're trying to de-risk by these investments by making them more liquid than they would otherwise be. Finally, I'd like to share with you some thoughts on why I think it's worth everybody's while to think about investing and consistently investing in the kinds of private equities that we're making available on the platform, right? As part of your ongoing portfolio management and allocation, why this is an important class of assets to be consistently allocating to. The first reason is that it's actually a very large and the fastest growing class of alternative assets. I'm going to share with you some numbers. I'm a numbers guy, so bear with me. So this is a table that's been put together by Prekin, who are one of the foremost firms that advise professional fund managers. And what it shows you is that the size of the total alternative investment market now is 6.5 trillion. And that's basically grown 2.7 times since 2010. Of that 6.5 trillion, roughly 3.8 trillion is made up of in private equity. So the biggest chunk of alternative assets is private equity. Within private equity, you've got leveraged buyout, right? This is equity that's typically accessed by investing in leveraged buyout funds, but the vast majority of it, 3.8 trillion, are in venture capital, equity, and other. So for example, angel investments are in this other category. So the investments available on Linqto span this 3.8 trillion. That's the asset class that we represent and make available to small accredited investors on our platform. And it's exceedingly large, because when you think about it, 3.8 trillion, I talk to a lot of our customers who are heavily invested in crypto, for example, which is yet another alternative asset class. It's not in this table, but that's an asset class that on a today basis probably totals about 650 billion in global value. So we're talking about 3.8 trillion, several times the size of the crypto market. So if you're invested in crypto, and I'm personally a believer in that asset class myself and invest in it, then there's no reason why you ought not to be allocating significantly and significantly more to private equity by virtue of that size difference. The other thing that is super important are the returns that derive from public equities. So this asset class has outperformed public equities during even the longest bull run, right, that we've seen in equities, which is the market since 2009 to the current time. You know, if you're looking at your brokerage account, you're obviously happy at that performance, but I will tell you that private equities have outperformed even your public equity shareholdings. And the other piece of news is that outperformance is anticipated to continue into the future. Again, I'm not making this up. Let me share some numbers with you. So this is some research that was done by Prekin and the World Bank. And it shows you that the value of private equity companies have grown 8 times since 2000. The blue line shows you the growth in public market equities. So you have much greater value appreciation during the same time period by private companies as compared to public listed companies. Private equities are the way that you participate in this black line growth. Here are the returns. So this is a fairly sophisticated analysis. I won't delve into the technicals, right? But it uses a method that in the investment management business is called PME. That stands for public market equivalent. And it's a means of taking an investment that's made in the private equity world and mapping it on a like-for-like basis with how the public equity market performs in the same time span. And then you kind of look at both and you say, okay, how did that dollar invested in private equity do compared with the same dollar invested in the public market, right? And in each case, you're using an index of private market investments versus an index of public market investments. This exercise was run by 2 separate firms, by Burgess and Cambridge Associates. They have slightly different modeling techniques, but it's the same basic idea of looking at a private market investment, comparing it to public equity returns. And here again, you see the black line that shows you the index for public market, and then the violet and the blue lines show you that the 2 different research firms measures of the public market equivalent return of private equity investment. So you can see the divergence on the positive side, meaning you're gaining and outperforming this black line across time, right? From 2008, so the bull market in public equities to date, and this study ended in 2016, you see the outperformance of private investments versus public equity investments. What does the future look like? This is a study that was done by AQR. This is one of the very first quantitative algo-driven hedge funds in the world. They're in Greenwich, Connecticut. They manage about 145 billion of money. And they've done this analysis to basically project over the next 5 to 10 years how they expect different classes of assets to perform. Look at the relative outperformance of private equity as an asset class versus all the different asset classes. So again, the point being, on a historical as well as on a forward basis, this is an asset class that you cannot ignore because it has outperformed and is expected to continue to outperform public equities. So how are institutional investors, when they're looking at this data, reacting? The answer to that is that everybody in the institutional world is increasing their allocation to privates, right? And obviously the question that's begged is, what does that mean for individuals like those of us on this call, right? If the institutional investors representing the biggest money, and hopefully the guys that have the most research talent out there and have access to all the best data, if that's what they're doing, maybe we should be following suit, right? I'll show you what those institutions are allocating today. So this is a study also done by Prekin. Each of these circles represents different classes of institutional investor, right? And what this chart shows you is their current allocation and how that current allocation is relative to what they call a target allocation. And that is an allocation that Prekin, based on their assessment of that particular class of institutional investor and what their risk return parameters are, where they should be in terms of allocating to privates. So insurance companies at the very bottom of the pack, right, are currently about 5%, and they're tracking about 1% gap between their actual and their target. So what that means is that they should be allocating about 6%, and they're currently at 5%, right? On the other end of the spectrum are sovereign wealth funds, and these are huge funds that are basically owned by nation states, right? Countries that typically have very large energy sectors or some form of long-term mineral wealth that's generating large current account surpluses for those countries, and then those countries set aside that surplus and invest it in a sovereign wealth fund to build wealth for future generations of that nation. Because of the very, very long-term purpose of that kind of fund, they have very long-term investment horizons, and therefore they can allocate significantly higher amounts to an illiquid asset class than, say, insurance companies that are having to set aside a lot of cash because they got to pay claims to you and me, right, on a current basis all the time. So sovereign wealth funds are allocating about 15% today, and they're approximately 1.5% below the target. So they need to be allocating closer to 16.5%, right? So on the low end, you have about a 5-6% allocation by insurance companies. On the high end, sovereign wealth funds are doing about 15-16%. And then pension funds, public and pension funds, they're around 8%, and they need to be allocating about 9 to 10%, right? So if the institutional money is doing, depending on their risk return in their time horizon, 5 to 6%, all the way up to 16.5%, right? Averaging, say, 10-11%. We got to ask ourselves, given our risk return parameters, are we more like insurance companies, more like pension funds, more like sovereign wealth funds? And where are we allocating in that spectrum? But that number on the low end should still be 5 to 6%. On the high end, it should still be 15 to 16%. So I'd urge you to look at your portfolios today and measure your private equity allocation against what the institutions are doing, figuring out where you are on this risk-return spectrum, and allocate accordingly. What we're telling you at Linqto, though, is it shouldn't be zero, because the smart money is well above zero. Finally, I just want to tell you that if you look at Linqto and what we specifically have on the platform today, you're probably going to realize that most of these companies are fintech companies, right? Or companies that are involved in the payments processing space, like Ripple Labs. Why is that? It's because, you know, we're actually having to make selections of these companies because we're using Linqto's own capital to buy this stock, right, in order to make it easily accessible to all of you. So that requires a certain selection. And the truth is that when you look at our management team, at least today, most of us have a background in banking and in capital markets. So that's sort of where our native smarts are. And so we're particularly focused on selecting companies that are disruptive and are going to be able to transform traditional finance, because that's just the space that we know best, right? And so we're particularly able, we think, to make good selections in that particular vertical. And that's the reason why you're going to see a preponderance of companies on the platform that are in that space, right? So you're going to see payments companies like Ripple Labs. You're going to see, companies like Uphold that are providing various forms of, custody as well as payment service and asset, exchange services. And then you're going to see fintechs like Robinhood, fintechs like, Kraken in the crypto space. And then, of course, Linqto, who are ourselves a fintech. This, we think, is a very, very important and exciting area for disruption, and we're going to remain focused on it because we know it particularly well because of our backgrounds, but also because it represents, we think, a very, very significant area for future growth in terms of equity value, right? I'm going to share with you a final slide that shows you an insight into what's happening in this space. So this is a table that shows you how global banks have, since 2010, been losing market share to payment firms and fintech companies, right? These are the disruptors. You'll see that in the first roughly 5 years, that disruption was relatively slow to occur, meaning adoption took time. But it would appear from this that the inflection point has been reached, and you see now an acceleration in the disruption. We think that this acceleration is going to occur more and more in the next 5 to 10 years. And that's the reason why we're very bullish on the sector, and that's why you'll continue to see companies in that sector represented on Linqto's platform. So with that, I'll open up for any questions.
Joe, I have a question because it looks like everyone else is shy or know everything. So there's always been a question mark of when and at what amount does an accredited investor really have the knowledge, right? So you have different countries with different regulations. So how's this determined of when you're smart enough to invest?
Well, in the US, our regulators' approach is to infer that you have a certain level of financial smarts and sophistication based upon either you're having a certain, financial standing, or you're having certain securities licenses that presume a certain level of, education training as well as professional practice in your day-to-day, right? So there is no sort of direct tests. It's all inference.
Thank you.
Other jurisdictions use different measures, but they all operate on a similar theory, correct? Which is that one can infer financial smarts and sophistication via these other markers, right? It's different than, say, how we determine whether somebody is able to get a driver's license. Well, we give them a bloody driving test, right? And if they crash the car, maybe you don't get a license. It's not so in this world. It's through inference, through those markers.
Thank you.
We have a question?
I think we have a couple of questions, Joe. Just seeing if the presentation and recording of our meeting will be available after.
I'm really sorry. I wasn't recording it. Was somebody else recording?
I did, Joe, and
Yes.
I'll make sure that I put it on our YouTube channel shortly after this call.
Okay.
Perfect.
Thank you, Mike. Thank you.
And then also, Joe, can we release the PowerPoint as well?
Oh, most certainly. Yeah, there's nothing proprietary there. I just stole other people's research.
Sounds good. And Santiago, Evan, I think that answers both your questions. I think John Murray had a question as well.
Yeah, why don't you read out the question? Joe, so the question is, do you have any insights into how university endowments are invested? Seems likely they'd be more long-term focused.
Yeah, endowments are allocating in the same manner that public pensions are. So they're currently in that 10, 11.5% allocation to private equities.
Okay, thank you. The other questions from Neil is, can Linqto support convertible notes now? Question mark. I know earlier in the year it was common shares only.
I think we're still focused on pretty plain vanilla instruments. I think over time we'll obviously migrate into other forms of securities in the private market space, but right now we're sticking to just plain equity.
So I have another question if nobody else wants to step ahead of me. Oh, Santiago, you have a question?
There is one question, yes, from
Okay.
Santiago.
Please. So I noticed a lot of the platforms that you offer are fintech related, some digital asset related, like Uphold. Is there any plans to essentially tokenize some of the securities that Linqto offers for some type of order book situation? I mean, you mentioned the fact that some of these are very illiquid. Is there any future plans for doing something like that, tokenization?
Yeah, our management team have talked about that concept, Santiago, and clearly that's the direction that not just us, but the whole industry will eventually move, right? So there's no doubt in my mind that at some point in the future, I can't predict when, not only we, but many people will be migrating to that world, right, where you achieve liquidity through tokenization. And that actually also blurs the line between a lot of other asset classes that are not in that private equity space, such as real estate, right, that then converge. Having said that, we're super pragmatic, right, because our view is that while the technology exists to do all of that, it's the more important thing for us right now is to solve the access problem, right? Which is that it doesn't matter how much you tokenize if accredited investors have no systematic and easy way of obtaining access to these investments, then it doesn't really matter how good the technology is. So we're more focused on trying to grow that access, right? To open up and make available to millions of people around the world. And that's literally, by the way, the addressable market. There is a Credit Suisse study that just came out a few months ago from their wealth management group that counted the number of millionaires in the world at over 50 million. That's just millionaires, right? So if you add non-millionaire accredited investors, you're talking some number that's significantly greater than that. That's a huge number of people. And I guarantee you, only a very tiny percentage of that populace are actually actively investing in this asset class today, right? Because of the access problem. So we're fundamentally focused on solving the access problem, and then we can over time create new products, including security tokens, right? As the industry moves towards more wholesale adoption of that. Our chief operating officer, who's on the line, is Miguel Villas. Miguel was responsible for heading all of XRP markets and the development of that market for Ripple into what it is today, right? Which is worth, I don't know what the recent market cap is, but it's probably the third largest market cap of the cryptocurrencies out there, right? So, Miguel understands that whole notion of building markets with new classes of assets really well. And so at the appropriate time for Linqto, we'll get into that, Santiago.
Thank you for answering that. A quick follow-up, if I may. Is there any talks regarding expanding the, at least U.S. domestic definition of accredited investor, or at least some legislative push? Does your organization work with others to try to expand that out, or is that something just not in the scope right now? There's a sufficient addressable market as it is.
There's quite a bit, this is Bill, sorry to break in on you, Joe, but there is quite a bit of tailwind in that direction, Santiago. So we are obviously promoting it and fanning the tailwinds, but ever since, Jay Clayton came in to the SEC, I think in 2017, I can't remember, just a few years ago. He's always been a proponent since the beginning of widening the rules. And remember, the SEC is a commission, a lot of people on it. They have differing opinions maybe about all of this, and many of them on the commission not only supported the recent changes, but want those changes to go even further. In one of the opinions, when the new ruling came out in August about expanding the who can be an accredited investor, one of the opinions that was posted came from Commissioner Hester Pierce from the commission, and she said this, I'll read from it, just a blurb. Why shouldn't mom and pop retail investors be allowed to invest in private offerings? Why should I, as a regulator, decide what other Americans can do with their money? The alleged justification is investor protection. People can't lose their money on investments if they aren't allowed to invest. Yes, that's true, but where does that principle take us? Someone who does not invest at all will not lose any money on investments. She will, however, lose. She'll lose the opportunity to see her money grow more than it could sitting in a bank account. She'll lose the opportunity to be part of enterprises that she believes will transform society. And she'll lose her right to make decisions for herself. I think there's a general underswell out there that, this is only a recent phenomenon. It used to be that just 5 years ago, a company got to a $500 million valuation, they'd be doing an IPO because that was their next step for getting capital. Now the companies are staying private to 10, 20, 30, $50 billion valuations. It just doesn't make sense anymore, but regulations always lag behind. But there is a groundswell there, just so you know, to widen that and change it.
Yeah. And the fact that the asset class has grown to the scale that, I had just described, and has also outperformed other asset classes, is putting a lot of political impetus behind the notion that you should allow much more access to it, right? Because if you don't, it sort of creates the impression politically that you're just letting the big guys enjoy the fruits of those returns, right? And the little guys, like all of us natural persons on this call, basically get frozen out. So the idea is, when on August the 26th, they opened up the regs to allow for people that hold certain securities licenses to qualify, even if they don't meet the financial test. That was the first step. And I think the next step is going to be increasing the scope of that of those certifications, meaning that maybe they'll get certain kinds of attorneys, certain kinds of accountants, certain kinds of, so different kinds of professional designations will then be allowed. And I think over time, there'll be more and more access to accreditation, right? What we can't write the regs at the end of the day, but what we're solving is, there's the other real problem, honestly, which is that even if you are accredited, how do you actually go about making investments? And how do you go about constructing a portfolio, right, given the amount of funds you want to allocate? We're making it possible for people to very, very simply and visibly see certain private equity offerings. And then we're keeping the minimum ticket size down so you can actually construct portfolios with a relatively small amount of money. Right, because I can take 50 grand and spread it across 5 companies if I wanted to, right? Whereas if the minimum ticket, like in the institutional world, is in the millions, then you're hard pressed to, or you're not going to take all of your net worth and put it in a single private company stock, right? So yeah, I think that we're going to obviously push as well as we can and advocate for more of the opening, but from a business standpoint, where we can really, really help solve the problem is by providing those people that are accredited much greater and much easier access.
Joe, Tony Moore sits here. I have a quick question for you, if I may.
Yeah, Tony, absolutely, man.
Sure. You might hear some background noises. I'm still driving. I'm on the road. My question relates to the accredited investor. Once you become an accredited, I'm wondering whether or not there's a time limit.
Yeah, I think the current regs require us to re-verify you every 6 months.
Every 6 months. And I also have a follow-up question here. Is if you did it with your spouse, and for some reason you may go through a separation, or you don't have that partner with you anymore to be recertified.
Yeah.
I'm wondering what's the alternative.
Well, first thing I tell you is that you got a bigger problem at that point than just accreditation.
Okay.
But
of course.
but seriously, the answer is you'd have to qualify as an individual.
Okay.
Yeah. There's one more good reason for staying married, right, Tony?
Absolutely.
Okay.
Joe, this is a bit.
Reporting for your wife, by the way.
Thank you for the answer.
So amazing! Thank you so much for the presentation, for the information. It's been great. We're at 1:05. Just wanted to point out quickly, there is in the chat window, there is the invitation for our next Lunch and Learn, which is Metals, Crypto, and FinTech. We have Miguel Valles and Brad. It's going to be really, really interesting, a very interesting Lunch and Learn, so sign up for that. Thank you everyone for the questions, for being here. I apologize for the slow start this afternoon, but thank you all. Next time we'd like to see you back. Invite somebody else, invite a friend, invite your spouse, Tony. And let's learn something together.
Thank you, guys. I appreciate the time.
We really appreciate everyone making the time to join us. Thank you very much to all of you.
Thank you. Have a great afternoon.
You as well. Thank you.
Okay, bye.
Great day, everyone.
Bye.